Your S Corporation paid your health insurance last year. $24,000 for the family plan. It's on your W-2, exactly where your CPA said it should be. But your deduction for it may be zero. Not reduced, but zero. Nothing on the return flags it. It files clean, the IRS accepts it, and you paid income tax on your own health insurance. I'm Cody. I'm a CPA and certified tax coach, and our firm works with more than 70 marketing and PR agencies every month. I see this one on intake constantly, and agency owners get caught by it more than most for a reason that has nothing to do with being careless. Tell me if you've lived this. You billed $2,600,000 of it is media, so your AGI is about $1.4 million, okay? Money that landed in your account and left, never yours. So your agency gross income is 1.4. AGI is what actually pays your salaries, including yours. Now somebody's retainer ends, not a disaster, just a Tuesday in this business. Billings barely move because the pass-through was never yours anyway, but AGI drops hard. And when AGI drops, what's the first line you cut? Your own salary every time. You'll cut your own W-2 before you touch the team because that's who you are. Meanwhile, the insurance keeps running. Nobody cancels the family plan because a client left. Your salary went down, but your premium didn't. That combination is what kills the deduction, and I'll show you exactly why in about 90 seconds. The second habit stacks on top. Agency owners take distributions instead of salary because distributions skip payroll tax. Often the right call, but hold one specific number down, nobody checks the other side. Quick version of the part most people do correctly. There are 3 steps. 1, the corporation pays their insurer, or you pay and it reimburses you. If you buy the policy yourself and the corporation never touches it, there's no plan and no deduction. Doesn't matter that you own the whole company. 2, the premium goes on your W-2 box 1, taxable for income tax, exempt for Social Security and Medicare. 3, you deduct it on Form 7206, flowing to Schedule 1, line 17. Search the topics and you'll find 50 articles that say exactly that and stop. One step before the part that decides whether you get the money or not. Your deduction can't be bigger than your earned income from the S Corporation. Fine, you say, I earned plenty. But here's the trap. For a more than 2% shareholder, the code doesn't define earned income as box 1. It defines it as your box 5 Medicare wages. So let's go back to step 2. Where does the premium go? Box 1. Where does it specifically not go? Box 5. It sits in a box that gets taxed and never reaches the box that funds the deduction. Small box 5, small deduction. 0 box 5, 0 deduction. The problem is the instructions bury this. The main text points at box 1. The rule that controls sits in a footnote to a worksheet on page 94. So $40,000 a month, client doesn't renew, you stop paying yourself in Q3 to protect the team's payroll. The insurance keeps running, box 5 collapses, the $19,000 in premiums has nothing to offset it, and you pay income tax on your health insurance. You did the responsible thing and got taxed for it. Flip it. Run $110 in salary against $22,000 of coverage, and box 5 clears the premium for room to spare. You deduct all of it. The salary you set is the ceiling on this deduction. That's a planning conversation, and it has to happen while there are payroll runs left in the calendar. Second trap, and small agencies walk into this constantly. Your spouse handles the books, your kid does social through college, neither owns a single share, both are on the agency's plan. Under the family attribution rules, the tax code treats them as owning your stock, so they're deemed more than 2% shareholders and their coverage can't be a tax-free benefit. It goes on their W-2 as wages. Spouse, kids, grandkids, parents, grandparents. Do it right and everyone's fine. The corporation deducts it as wages, they claim the deduction on their own return. Do it wrong and the money just disappears. Corporation loses the deduction and they get nothing. So here's a little bit of mercy. Siblings aren't on the list and neither are in-laws. So your brother-in-law who runs new business doesn't trigger this. If this describes a year you already filed, you can usually amend filing in 2026. That generally means 24, 23, and 22 are open. 22 will close first. So here's the last one, and this is where the real money is. You went remote, 12 people across 6 states. A single group plan handles that badly, and the price is worse. So the instinct is to tell your senior copywriter, buy your own plan, I'll cover $400 a month. That instinct costs you $100 a day per employee in excise tax. Do it for 4 people and you're at $146,000 in penalties on maybe $30,000 of kindness. So you want to do this right. 2 legal ways to do the identical thing. A certain type of HRA capped in 2026 at $64.50 for a single and $13,000 for a family, or what we call an IC HRA where there's no cap. For a distributed agency, the IC HRA is usually the answer, and it's the one nobody's heard of. Everyone buys coverage that works where they actually live. You fund it, and you can set different amounts by class of employee. Same generosity, one version's free, the other costs you a ton of money. Both cover W-2 employees, your freelancers are outside both, and a stipend doesn't fix a classification question. So here's your 90-second homework. Pull your last W-2 from your own S Corp, look at box 5, then find the premium, usually box 14, coded something like 2% shareholder medical. Compare them. If box 5 is the small number, you didn't get the deduction, the thought you got. Then do the forward version. Look at where your AGI is actually landing this year versus what you assumed in January, and ask whether your own salary still fits the year you're having. Filing a tax return isn't a tax strategy towards what already happened. This is the kind of thing you catch while the number is still movable. If you want a second set of eyes, there's a link below to book a free tax analysis. We'll look at your last 2 filed returns and tell you plainly whether this one got you. All right, before you go, if you're an agency owner and you want to keep more of what you make, I've got 2 things for you. First, grab a copy of my book, The 12 Biggest Tax Mistakes That Cost Agency Owners Thousands. It breaks down the exact mistakes I see every day and how to avoid them. Second, if you want to see what this looks like for your business, get a free tax analysis. We'll take a look at what you're doing now and show you where you might be overpaying. And if this video helped you, make sure you subscribe so you don't miss future strategies on tax planning, cash flow, and building a more profitable agency. I'll see you in the next video.